Okay, let's do some Q&A from the comment section from the last market update. I haven't had a chance to read any of these, so I'll be reading these for the first time. Some of them I've seen as they show up on my YouTube app that I have on my iPad, that just kind of like a notification. You can see part of the question. Other than that, I haven't seen these. I've been a big fan of mortgage REITs for years. Given the level of leverage across this industry and rising interest rates, I can only expect the cost of capital to increase. As you pointed out, most risk is hedged out and the focus is on the spread, ignoring the servicing rates income portion of revenue. Is this migration to higher rates a short-term impact or a fundamental change that strategically affects this industry? Well, if you have a spread that comes down to historical levels, but with higher funding costs, if there's a belief that those funding costs are stable, you can then use leverage. So you can still bring in a certain amount of leverage, because that's what you're doing. You're leveraging the difference between your funding costs and that spread. There is some Fed speak that suggests that the era of low rates is gone. That's it. They're never going back to that. I think if you have higher rates, you have higher mortgage rates, it might affect origination, which means it might affect the supply of mortgage-backed securities that exist. So it could be that portfolios stay smaller or get smaller if you don't have the level of issuance. I don't really, I don't really have much of a forecast on what would happen there. But I don't think that the business model would be affected. I think higher levels of leverage, and again, this is a big if you have stability in rates. So if the central bank says, you know what, we're going to have these high level of rates for a long period of time, and if the market believes there's a high level of rates and the volatility of these rates drop, then yeah, you could increase the amount of leverage that you use. Let's see, I like this intro. The transition after the 1-2M part seems a bit choppy. My suggestion would be to just move to the original M to the side and then insert the company. Okay. Trying out a few iterations. We put something up, get some feedback, try something else, get some feedback, and eventually I'll get to something that everyone has no comment about. When you have no comment about it, it's like, well, okay, it's there, that people see it, but innocuous enough that it doesn't cause anybody to say, dear God. Some analysts base their whole market view on liquidity. However, it's never clearly defined. Well, liquidity can be proxied by the bid-ask spread, right? The wider the bid-ask spread, the less liquidity that there is. Is it something we should incorporate in our analysis? If so, how should we look at it? Fixed income, sure. Equity market, not really. Some equities are fairly illiquid in the sense that they trade very few shares per day. Mostly ETFs with a low amount of assets under management. And options, if they exist on some stocks, end up being so illiquid that you ask the question of why they even exist. I mean, when you have a bid-ask spread that's $1 wide on an underlying that trades 20,000 shares a day, such a low average daily volume, you think, why do you even have the options? I mean, I see no volume on these options. Why even list them? No, I don't know that I'm too concerned about liquidity. For the retail trader, I don't think it's really important. For the market as a whole, can liquidity affect certain parts of the market? Well, we saw it in the banking sector with deposits leaving. That's a liquidity issue. I think after the debt ceiling debacle is over, and it will be over, there will be a flood of T-bills coming into the market. That will take liquidity out of the market, obviously, because money is going to be absorbed into those treasuries. So it will be a sort of like a vacuum sucking out liquidity out of the market. I don't know that it'll affect the major indices. Like if you're playing around in the S&P 500, I don't think you're going to notice anything there. If the debt ceiling debate continues into June, what kind of correlation should we expect between stocks and long-dated rates? Rates will probably. That's a hard one to tell, because as this goes longer and you get closer to the central bank meeting, if you have a central bank meeting with no resolution, I doubt that central bank will move. So it could be a pullback in yields, which means a support to long-dated bond prices. There could be something there, because why would they raise rates with all of that nonsense going on? Continuing into June, that's a tough one, because I think both sides realize that there is no winning here. But one side, the Republicans, and I think I agree with them on this, is that they can dominate the news cycle, being the champion of the people on this one, because I think it is just widely accepted that the level of debt is off the charts, literally off the charts. So by saying you have to cut down spending, is not a message that most Americans would say, oh my God, can you believe those Republicans? I think on this one, they probably think, well, I hate to say it, but kind of agree that you got to cut down. And listen, if you're what's called a classical liberal, this used to be what liberals were, classical liberals. Now they're, lefties. And have gone just kind of off the cliff on that. But a classical liberal was a social liberal. In other words, do what you want to do, be who you want to be. It doesn't really matter to me. I'm not going to regulate you in any particular way, and I'm not going to, curtail any rights for you. Be what you want to be. However, they were also a fiscal conservative. That's sort of has been lost, and social liberalism now has gone so far left that it's almost racist in itself, and fiscal conservatism is just being thrown out the window. But if you're a classical liberal, you sort of have to side with the Republicans on this one. So the longer they can keep it going, I think he's got a deal. I think he's going to make a deal. The Republicans are going to make a deal. But the longer they can keep it going, the longer they dominate the news cycle, the more they look like the party that wants to be rational about how we spend taxpayer dollars, right? But I think there'll be a solution. But they're going to milk the news cycle for all the free campaign coverage that they can get. Ooh, look at this. Downside in trophy buildings. Would you see it being a significant risk for a business like Brookfield? Well, they have walked away from some properties already. Their stock recently fell in the news that they defaulted on their office building mortgage. Yep. That being said, the underlying buildings on which they defaulted on might have been low-quality REITs or low-quality buildings in their portfolio. And that, as per their CEO, 95% of the REITs are high-quality ones. I don't know that I would go that far. I think it was just that the property price had fallen to a point where the mortgage didn't make any sense. I understand IFRS requires change in fair value to flow to bottom line, or rather that Brookfield has elected the fair value model under IAS 40, so overall bad for the financials. But my thinking is they would simply hold their REITs, collect rent, and pay their mortgage while the fair value of their REITs recover. It's the type of financing that are on REITs. They don't have, if you get a mortgage on a house, you can get a 30-year fixed rate mortgage in the U.S., right? But commercial property tends to be shorter, tends to be 3, 5, 7 years. And it's while a residential mortgage is what's called fully amortizing. That means that if you draw out the principal over time, the principal tends to drop like this. But most houses, if you have, this was their mortgage, their property value would be higher. Most houses tend to do this, so you have this widening gap over time. So there's not a lot of risk in putting in a 30-year fixed rate mortgage, because a house that you buy today in 20 years, chances are has a higher valuation. That is not so for office buildings. As office buildings age, they go from prime properties to secondary properties. They actually, it becomes, because they're out of date, so it becomes harder and harder to justify market rents. So buildings over time have a harder time, unless you have CapEx that continually goes in, it's hard to maintain it. The commercial mortgages tend to be what's called partially amortizing, which means that you do have a bullet payment, and we'll just take the 5 years and assume that the average lease in a building is 5 years. You have a certain loan to value ratio, and your property value is uses the net asset value method, which is just your net operating income over your cap rate. And you have to maintain, for your property value here, and you have to maintain some kind of loan to value ratio. Well, if your property prices are dropping simply because you have high vacancy rates, so your NOI is low, it's questionable whether or not a bank for a loan would allow you to normalize your NOI. If you're a buyer of a building, you might think about normalizing NOI. That means normalizing it for full occupancy and then deducting from the price the amount of rental income that the present value of the rent that you would be foregoing. I'm not sure if a bank would allow that. So it's sort of like a test every 5 years or so on commercial real estate to make sure that the property value still exists for the amount of the loan. And because it's partially amortizing, sometimes just interest only, but usually partially amortizing, you have that bullet payment in year 5 that you can typically roll over for another 3, 5, or 7 year period if you can maintain the same loan to value. So I believe the Brookfield situation was one where the loan that they would roll over, the bullet on the loan that they would roll over, was greater than the property value based on a NAV model, in which case you simply just walk away from it. Let's see, where did we leave off? So overall, but my thinking is we did that, right? Regarding the seemingly contradictory stories of huge projected growth for NVIDIA versus decreasing investment spending for mega caps, I wonder if these two stories could coexist. Well, they do coexist. They do coexist right now. Given compression of margins since 2022, companies are focused on becoming leaner and more ways to cut investment activities. And the other hand, NVIDIA could see a slowing of growth in the next quarter or two, only to pick back up in a year. I don't have the actual Wall Street estimate though, but if I had to choose either, I would say NVIDIA growth is too optimistic for sure. Well, they have increased in price since the beginning of the year over 100%. And it's the AI fever, I think, that really pushed them up. Now the fundamentals are going to show up, and they show up tomorrow night, Wednesday. Where are we now? We're May 23rd, Wednesday, May 24th. The fundamentals are going to show up. And it just seems curious to me that the companies that would be scaling up for AI actually scaled down their investment and extended the useful life of their servers from 4 to 6. It's like, I thought this stuff took more computing power. So if NVIDIA knocks it out of the park, then you sort of have to ask the question of, well, what's going on here? These are two different stories. So yeah, I think one of these stories, just logically, doesn't seem right, but it's kind of like a puzzle, right? Where you have this going on, and you're missing a piece of the puzzle here. Maybe I'm missing a piece of the puzzle, and I don't quite understand what's going on. As for extending useful life of assets, pretty sure it's just to fabricate a higher net income and EPS. Yeah, I'm curious about that. It's not the first time they've done that. How many times can you keep extending the life of your servers, right? Let's see. Curious if you might have any thoughts on the relationship between theft and unemployment in the business cycle. When you say theft, I'm not sure what you mean by theft. Crime is opportunity related in the sense that if there is little economic opportunity, you typically see higher levels of crime. Only because, what else am I going to do? I got to get by. Number one. Number two, I want stuff in life. So how am I going to get that stuff in life? And if I can't make it, well, then I've got to take it. So there is a relationship between economic opportunity and crime. But I'm not, it's such a broad question. I don't know exactly where you're going with that. Here's context, right? Companies with a lot of brick and mortar have been including statements in an earnings call about shrink theft. Well, shrinkage there's always been shrinkage affecting top line, with the rate of theft growing in the past few years. After a quick scan of abstracts from Google Scholar, there doesn't seem to be a consensus on whether the business cycle has a link to crime. Regardless of the literature, I personally believe there's a logical link between recession and higher rates of theft. Yeah, and I believe the driver is the relationship of unemployment rate and theft, as those without incomes may need to resort to theft. Yeah, but listen, we have the lowest unemployment rate in 50 years. So we should not see a growing amount of theft. You should see a reducing of theft. My mental model would break down when using the recent initial claims data, as the job market is fantastic for job seekers currently. Well, there it is. The jobs report gravely understating unemployment. You could just say, maybe I'm missing something else. Maybe there's another variable. Employment does have an impact, or unemployment does. So if we're seeing an elevated amount of theft at retail outlets, but you have a robust job market, then the variable you have in question, you're trying to make the variable fit. Maybe there's just another variable. We know in cities like Chicago and San Francisco that have taken a more, I'm not even call it liberal, a more lefty approach, that I think San Francisco is like, if it's under $800, we're not going to arrest them. So what does that do? That simply just invites it to happen, because what's the downside? Somebody grabs it from you on the way out. Well, you just walk right back in and fill up your bag again with $799 worth of stuff and walk out. They're not going to arrest them. What's your downside? So, the fear of arrest can keep crime at bay. But if there's no fear of arrest, it's kind of like The Purge, right? I mean, you've seen the movie The Purge. Is if there's no repercussion for what I'm about to do, why the hell wouldn't I do it? There could be, it might just be that variable. I know that maybe there's the more inclusive side of you might not want to say that, but if you give people permission to steal, there is a group of people that will steal. Not everybody's a wonderful human being. That when you open up the door for the excuse that, well, because of disparities, because of this, because of that, there are people who will look at that as weakness and take full advantage of it, because they are not good people. You don't have to be in a white wrapper to be considered a bad person. Bad people come in all kinds of wrappers, right? So maybe it's something like that. All right, for floating rate CRE borrowers, where would we look in the financials to see the degree of interest rate hedging that they have implemented? In the notes to the financials, look at the table of contents, look down for interest rate hedges or debt schedules, and it will be in there. Would we be able to see when the maturities of the hedging vehicles are as well? Yes, you will. An example of this would be great. I don't really have an example handy at this point in time, but go to any company that has debt. Go to General Motors. They got quite a bit of debt. Or go to Ford and get their 10K, their most recent 10K or 10Q. Look at the table of contents, and if you're using Edgar, you can use the interactive data, and you could just click on notes of the statements. You could scroll down, you'll find the debt schedules, and you'll also find maturities. How much is maturing in the next 12 months? Usually it's over the next 5 years, what's maturing in 2023, 2024, 2025. If they're using any hedging instruments at all, that'll be disclosed as well. So you can just look it up. Let's see. Curious to know which companies with floating rate debt are efficiently managing their liabilities versus ones that are not. I would assume unhedged borrowers with Class B properties would be the first to break. Yes, they would. They would be the first to break. Many of them are breaking already and have broken. Quite a few in Canada that I can think of. There's 3 or 4 that have just broken, cut their dividend, and their share price is a shadow of what it used to be. Let's see. Since most of the rally in the S&P has been led by the top 5-10 stocks, do you think it provides a real-time example of the quirks of the incentives created for active fund managers? Well, I need to know more about what you mean by that question. Yeah, I don't know how to even begin to answer it because I'm not even sure what it is you mean by the quirks of the incentives created. Yeah, I don't know. I don't know what you're thinking there. I read a Bloomberg article which stated that from August 22 till the end, the 5 largest underweight stocks at that time by most active managers were the same tech names rallying currently, and they trailed the rest of the market by 24%. Yeah, they didn't do too well going into the end of last year. At the start of the year, when people started buying these tech names, the fund managers' low weights in these names began to make the performance look bad compared to the benchmark. As a result of this, fund managers are forced to chase these names and pound more money into them. And that creates a momentum effect. Do you think it could be a major reason for the current market rally versus the current prevailing narrative that the gains in these tech names are due to the optimism around AI? It could be. It could be that they went into the beginning of the year underweight these names and quickly had to shift into overweight. It could have been just a change in the new year that they did go overweight and thus created the rally which everyone jumped on. But no, I think the AI mini bubble that's forming inside of this is a real thing because it seems like almost every company now is racing to say that they're embracing AI. Today, the CEO of Zoom was on talking about their results and said, we're incorporating AI. And I thought, oh, come on, it's me and somebody on a screen talking. What AI could you possibly, what are you doing here? Everyone's throwing around the word AI just to see what will happen with their share price. And sure enough, one of the interviewers pushed back and said, well, where do you see that benefiting? Where do you see that benefiting? And it was like reaching for anything here. What it can do is it can summarize the chat if you came in late to a meeting. The little chat things where you put comments. It can summarize the chat for you if you came in late. Okay, you're really reaching now just to get the words AI in there, just to throw the words. Everyone's throwing it out there. So it's just, it's become to have a life of its own because it just seems to be everywhere and it's capturing everybody's imagination. And, the idea of these productivity gains and corporate margins, a whole bunch of different research reports in this. Corporate margin can go from 12% to 15%. It'll increase earnings by 30% over the next X amount of years. With the labor shortage, this is the absolute answer for what we have. This will bring down inflation. It'll be deflationary. Margins will increase. We're going to live in this heaven on earth and blah blah, and the story's not done. So I think AI has a lot to do with it, and it's starting to infect the market as a whole, to the point where almost every company is trying their best to say we're going to use AI for this and AI for that. And yeah, I would not at this point discount the euphoria around AI and just the sheer willingness of investors to say, we don't need to see results today. The story is compelling enough, much like the internet in the late 90s, because I remember that, is no one really knew what it was going to be, but everyone had this narrative started getting a hold that malls are going to disappear, everything will be online, universities are going to disappear, all of this stuff will go away, bricks and mortar are dead, it's all over, and everybody was rushing online. I mean, ridiculous companies were getting funded. And if you want to watch a nice documentary of that time period, there's one called startup.com. Startup.com, if you can find that one. It's about a company, they call themselves GovWorks. Well, not with the dot, govworks.com. And it shows you the absolute euphoria at the time for everything, that everything was getting funded, and then it all broke. It all broke. And I think AI is going to be the same thing. It's I think what got funded today, there was a company that doing AI something, they raised a $440 million round. $440 million round. I want you to think about that for a minute. Right? That's crazy. Let's see. Okay, do you believe in the narrative of silent, unspoken Fed put, which has existed in the stock market during the past downturns? Do you think that this time there may be a silent Fed call? 42, 42.50 seems to be the range for the same. Market seems reluctant to go past this level. The August 2022 highs were also in the same range. I don't know that the Fed is playing games with the market in that particular way. I think they don't want to see financial conditions ease. I think they're pretty clear about that. And if there is going to be this IT revolution and this AI and companies are start embracing it, they're going to have to pull IT staff in. And they're already brutally difficult to find. That's only going to add more wage inflation. Because the promises of AI are years down the road. It is far from perfect. So it is highly in the testing mode right now. I've got the subscription to ChatGPT 4, and I'm not going to call her my assistant. She's more like an apprentice now. I've got her using it along, because she's preparing for her level 1 in February of 24. I've got her using it just to see how it can handle things. If you got a question, use it. But only ask it questions you know the answer to see if it's right. I think there's a lot of testing first to make sure that this stuff can that you can rely on the output of this stuff. So I think that maybe in the next 12 months you might find a few jobs here or there that are now being done by AI, but not this wholesale cleaning out. I think that is several years down the road before that starts happening. I don't know that that AI is going to lead to wage inflation before it leads to wage inflation, right? This intro is so much better. Okay, good. Good intro, by the way. Yeah. I'm browsing Fred for the following charts. Can't find them. MBS spreads not on Fred. You're not going to find that on Fred. Agency MBS issue. That's on SIFMA. 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 Fed's MBS purchases. That is at the New York Fed. New York Fed. And you can Google New York Fed and SOMA. And you will be able to get that. Let's see. What is your take on the recent raise of the long end of the curve? What do you think is causing it? Well, I think the bond market believes the Fed. I think the bond market is doing the right thing. It I think is the only one that's actually doing the right thing, because the cash flows are known. So the only thing that can change the price is that discount rate because the cash flows are fixed. So the bond market tends to be smart money. That it is going up, I think it is hearing what the Fed is saying, higher for longer. And the data coming out is really not suggesting that the Fed is going to be cutting rates anytime soon because inflation does seem to be persistent. It's hanging out there. The frothy inflation part has come down, but the sticky stuff, well, it's called sticky for a reason, right? So I think it'll be there. I think the bond market has it. And I think the bond market is if we're looking for rationality, the bond market is showing that. If we're looking for irrationality, we look at the equity market because the equity market is looking at the bond market saying, you know what, you guys do your thing, we'll do our thing. And the equity market just doesn't seem to really care much. I mean, Monday morning, out of the gates, you had a Fed, an FOMC member say, I think we have 2 more rate increases ahead of us this year, 2 more. And the market did this and then went like that and just said, oh, 2 more. And they stepped in. No, don't care. Eye on the prize, 4,300. Doesn't matter what comes, eye on the prize. And it just didn't matter. Because, well, listen, the debt ceiling is going to get taken care of. They're meeting this afternoon. Listen, these are politicians. They're not going to give up free campaign coverage on the news cycle. They're not going to give it up. Yeah, they probably got a deal. They probably already know what they agree on. But they're going to keep this going for as long as they possibly can to campaign for free because, well, campaigning costs money. This is free campaign coverage right now. They're not going to give it up. Well, there was no deal on Monday. So they met today and, as the news was coming out, nope, down went the market. I don't think that the equity market gives a damn about the rates anymore. Which is odd because it is the discount rate for everything. That if you have a perpetually higher bond market, bond yields, if you have perpetually higher bond yields or bond yields for a number of years, you must adjust the cost of equity. The equity market doesn't seem to get that. I find that odd. But if you say, well... what was it? Facebook said something about AI and they went up like $8 to $10 in a couple of days or in one day just because they started talking about it. That's it. Every company's going to start saying AI this, AI that. And my God, if the market goes up like it did in the late 90s, there were people in the late 90s that said, this is ridiculous. I even remember Fortune magazine at the beginning of, I think it was 2000, started a dot-com graveyard. There was a section in the monthly, was the dot-com graveyard, because it was just known that this is ridiculous. Everyone thought it was ridiculous, but who's going to stop? Right? Until it finally just ends. Until it finally ends. What's going to end AI at this point? I mean, other than the government coming out with absolute strict regulation that every AI program must get permission from this government agency, then I don't see it stopping. Where are we here? Q1. Could you share your outlook on China-related exposure, considering that currently most of institutional managers are underweight China? In recent discussions of Biden and Xi about U.S.-China relations getting better in the near future, are you planning to add any exposure to China? Never had any exposure to China. I see no reason to add any China exposure. I think the closest I get to China exposure are companies that would supply things to China, like raw materials. But beyond that, I have no desire to get to know the economics of the country. You can only know so much. You can only know so much. And after a while, you have to start listening to other people who are experts in other things. I am far from an expert in China. There are probably people on YouTube you can find that are experts on that. I am not. And you know, as a human, you have limited bandwidth. You can't possibly know every market, every asset, every currency. You can't possibly know everything. And I follow a rule of, if I don't understand it and I don't know it, I don't touch it, because I won't know when it's wrong. I won't know when the risk is too great because I don't understand what I'm doing. So yeah, that one I just don't have answers for. What are your thoughts about high dividend yield portfolio considering current market conditions? For example, realty income, well, REITs, 99% occupancy, trading at relatively attractive prices. Doesn't matter. Doesn't matter. All REITs are bond-like because they have leases in place or rents in place, so their cash flows are very bond-like. And if it is 99% occupied, where's growth going to come from? Like what, 100% occupied? It can't be 110% occupied. So where's growth going to come from? And you have to worry about the cap rate, which is the cost of equity, right? It is the cost of equity minus the growth rate. Well, if they're fully occupied, and you have pressure on market rents, and market rents are flat or coming down, your NOI growth rate is going to be lower than historical norm. Typically in the long term, it approaches nominal GDP. But we're seeing rents, especially for commercial real estate, rents coming down. And then the cost of equity is up. And one thing I think that this market is forgetting, if you think about the cost of equity for real estate, it can consist of a risk-free component. It's a long-lived asset, so there's a term premium as well, and it typically has a credit spread that is equivalent to a B-rated OAS, high yield, B-rated OAS. Or if it is a high-quality building, its credit spread is whatever the average credit rating of its customers are. Plus, you have some equity premium as well. And being in the market that we're in, whenever interest rates go up, credit availability drops. When credit availability drops, the illiquidity premium goes from about 2% to 4%. So when you add up the probably higher spread that you're getting, the higher level of risk, the higher risk-free rate, and definitely the higher illiquidity premium, I'm surprised the IYR hasn't broken down below 70 at this point in time. It's still hanging out at 80s and still deciding whether or not higher interest rates are a negative for cash flows that are very bond-like. So no, I would not, I'm out of equity REITs 100%. I wouldn't go in them, touch them, or be anywhere near them. Get your thoughts on Verizon, AT&T. I don't know. I don't know those companies. Again, as I said earlier, you can only know so much. And there are some sectors of the economy that I just don't play in. Sincere condolences to your coffee mug. Yeah, that was his 20 years. 20 years. It was the end. My question is, why does the market even rally on the positive debt ceiling news? You know, I've asked myself that too. Somebody on Bloomberg said, you know, if we get a resolution to the debt ceiling, we could get a good relief rally. And I thought, whoa. You get relief from pain. What pain have we had? The market just kept going up and up and up to 4,200. Even though we knew this debt ceiling thing was coming, even though we knew it would be a clown show, we knew this would happen. The market kept going up. Oh, it'll be taken care of. It'll be taken care of. So that how can you get relief when you haven't had any pain? It's like taking Tylenol when you don't have a headache. It's like, well, if I take Tylenol, this, you know, I'm going to get relief from this headache I don't have. I ask the same thing, is that how can you have a relief rally when you haven't had a pullback on it, when you haven't had anything happen? Now, you probably will get something in the bond market. For sure, the bond market deserves something, especially the front end of the curve. The bond market does deserve some relief there. I get that. But why would equities suddenly enjoy something from the debt ceiling being lifted when there'll be a flood of issuance from the Treasury that will soak up liquidity out of the market. To me, it just doesn't seem to make sense. But I get the very strong feeling that we are in a market right now dominated by financial participants that have absolutely no economic training whatsoever, right? When I was young, I did a lot of solo sports. One of the things that I enjoyed a lot was fight training, and I took Shaolin. Is one of the things that I did. Shaolin. It was a Hungar version of Kung Fu. There is also Wu Ti. I did that one later, but Hungar. And the instructor, well, they're actually called senzais, but the instructor at the time posed a question. And I never forgot this question because it does matter. Would you rather fight a highly trained person, or would you rather fight somebody who's completely insane with no fight training? Now think about that for a moment. The trained person will know when they're beat and will know when you're beat, but the insane person won't. You would have to inflict absolute damage on that person, or they would have to inflict absolute damage on you because they don't know the rules of engagement. Another good story is if you go to Vegas and you play blackjack, there are certain standard rules of when you would stand and when you would call, and when you would say, when you take a card. And when the person beside you has a hand where they should be standing and they take a card and you look at the card and it's your card, it's like, it's hard to play when you're playing at a table of people who don't know how to play the game. And I feel that's what we're in right now with the equity market, is just a significant amount of market participants that I feel have absolutely no economic training whatsoever, because none of the macro things are working. I've never been in a market that has just been this odd to play. Sometimes it works out. Other times, something that is so clear and obvious, up we go. And I think, we're going up? You must be kidding me. How can we just ignore this thing? And up we go. So, I don't know. Unbelievable how the market keeps going under these conditions. Sucks to be short right now. Yes, it does. Yes, it does. I am absolutely, unshakably certain this rally wasn't due to the Biden reassurance. It was the mug. I think you got something there. Are you familiar with Russell Napier's work? Yes, I am. Smart guy. Last person who gave you CS. Yeah, I watched that one, by the way, and I do have something to say. He was giving an incredible presentation, and the camera would flip from him to the audience, to him to the audience. And every time it went to the audience, everyone had their little phones out. They were looking down. One guy was yawning. Somebody was looking around. I was thinking, what is wrong with you people? Like I would be, you got to be soaking in everything this guy says. You should be holding up your phone to the screen and taking pictures of those PowerPoints. I mean, come on. But the audience appeared to be so bored. I wonder if it was because, well, you show up, you mingle for a while, maybe there's some presentations, some people were awarded their charter, you had a dinner, and then you had this, and you're into hour 3 or hour 4, and everyone's sitting there. But yeah, watch it, and just watch the audience. Half of them are bored to death, can't wait to leave. One guy kept, at the front table, keeps looking at his watch. Anyways, yeah, it was a good presentation. Let's see. You are saying the short beta position is potentially standing in front of an AI tech irrational momentum wave. Yeah, I'm more and more each day. I'm getting the feeling that that's what's going on. Could we also assume there'd also be unexpected resilience in the face of an exogenous shock? Well, you tell me what kind of exogenous shock, and I'll be able to answer it. This morning, Barkin said he supported 2 more hikes, and the market shrugged it off. No kidding. When he said 2 more, I thought, okay, well, You can't knock, you can't just look past this. And I saw that red bar go down. I go, finally. And then I saw the green bar, just as big as the red bar, go right back up in the next 5 minutes. And I thought, you gotta be kidding me. And that's when I started feeling that, okay, that's it. I mean, what else can be said? I mean, the next guy would have to say 3 more rate hikes because you've already heard 2 and you don't care. So at that point I thought, well, what more has to happen? Nothing can be said. It actually has to show up. And I've said this on the market outlooks that we're in this kind of market right now where I could tell you that, there's somebody coming that is going to slaughter all of us, and no one would leave the building. Not until it actually showed up would somebody leave the building. But you could say there's a real important person, a movie star, coming to visit the building, and everyone would hang out. I'm not leaving until they get here. And that's the market. It is asymmetrical, where you can say, look, this bad thing is coming. Or you could say this good thing is coming. Great, let me get my wallet. All right? Anyways, yeah, it was yesterday that I started thinking, well, it's irrational. Okay, we got 2 more Fed speakers, or there were 3 more that day, and Biden. I thought, well, I'll wait till the end of the day. There seemed to be some kind of rationality that came in, and then 7 o'clock last night, the futures went right up. And then a little while later, they went right up again. I'm thinking, okay, nothing's going on. Nothing's going on. Somebody somewhere said, yeah, I think we can get it done. Yay! And I thought, this morning, for sure, I thought, okay, I'm rolling up all my puts. I'm rolling forward whatever I can. I've got to add another 50, 60 points of carry somehow. And then I got the day that I got, so I thought, okay, not bad. On your TLT short put positions, you said you rolled out the May 104 to avoid assignment. Yeah, because they were in the money. So why not take the profit? And I would have opened up the June 104s anyway, so why not just do it all at the same time? Can you provide the figures you were seeing at the time of the trade? 191, I think 49 cents on the cover. I do so many of these a day, it's hard for me to keep it straight, but it was almost $1 on the gain, and then I think the roll forward I got, because I sold more at higher prices. I think my average price now is 191 on the 104 puts. Meanwhile, their market price on them is $3 and change, so I am well underwater on those. Do you think the market is courting the idea of a high discount rate regime that could prop up the long to the curve indefinitely? No, not indefinitely, because you will break something. Something will break. It always does. Because you get an economy that fits itself into a certain yield curve that we had in 2020, 2021, 2022, or at least up to the beginning of 2022. And now you have this different type of yield curve. It's kind of like clothes that don't fit. And when you go to the closet, and all these companies eventually have to go to the closet to get the new clothes out, it's not going to fit. So something always breaks because of that, because you've sized yourself to a certain type of yield curve, a certain type of slope, and you've molded your business model somewhat around that. And your income statement is molded somewhat around that when you change that, you break things on the way. And sometimes it's enough to break companies. You're seeing it in the commercial real estate sector now, because they tend to have shorter maturities on their debt. So commercial real estate tends to have the shortest maturities, followed by high yield. High yield, usually when they issue, they're 7 to 9 years. They typically issue a senior secured, so there's usually assets backing that. And then IG is usually 15 years plus, sometimes up to 30 years. And this is typically issued as senior unsecured. So we're seeing it here already. And as time continues on, if you have rates higher, it's eventually going to start to show up in some of the high yield. And typically it shows up by, credit migration down to triple C. So you keep your eye on that. Right now, the OASs, the spreads just don't seem to care. There doesn't seem to be much going on in terms of that. But something somewhere always breaks. So I don't know that you're permanently at that or indefinitely there. Rather than the validity of that thesis, do you think the idea could gain wider acceptance to cause TLT to stay below 100? Well, I think TLT will probably hang out at these levels for until it appears that a recession, the probabilities of recession have increased dramatically. So if the Fed raises rates again, you have the paradoxical outcome that the yield curve could invert even more because short rates go up to reflect central bank rates, to reflect the overnight rate, but the long end goes down to say, okay, you are going to break something at this point. 20-year broken coffee mug. That wasn't comedy. That was sweet, sweet sorrow. He definitely puts, I wish you would in your videos touch on SPY. Well, I do. Maybe QQQ and IWM. I don't really get too much into QQQ. Had one hell of a rally. The volatility on it is high enough. The premiums are there definitely, but it tends to move on. It has, I think, less attachment to macro fundamentals. So NASDAQ is, I find, more of a bottom-up index, whereas S&P has historically tended to respond to a top-down narrative. Now, the difference between IWM and SPY depends on where in the business cycle we are. Typically, the triple Qs and IWM are great when the economy has had a recession, when you've contracted and the central bank is lowering rates. And while they're lowering rates, that is typically when you'd cycle into those from SPY. So I don't really go too much into that. I think you've noticed that I'm very top down. I'm not big bottom up. Like, you could do bottom up, which means that you're really more concerned about individual companies and that's it, and you might just talk about a whole bunch of companies, but I tend to do more top down, and I really haven't gotten too much into the Qs. Again, you can't know everything. You sort of have to have a limit of where you want to be. So my recommendation would be, there's some good people out on YouTube. You just have to get past, the ones that are hyperbolic. Bitcoin's going to 1 million. Housing's going to crash 40%. Like, just avoid that nonsense. That's for clicks. But there's some good people out there, and you'd have to curate, a watching list of, well, this guy knows, energy really good. And this guy knows China really, really well, and this guy knows that, like Russell Napier, if you're looking for at the level of the currency globally, that's the guy. So you tend to watch a number of people who know, who have their own wheelhouse and know their own thing, right? Understand your play on GM and how you're using the options to manufacture better dividend return. I see the long-term thesis of holding GM. I'm just wondering, though, are you concerned about long-term debt? Not with their cash flow. And with ICE now, ICE is, as I said last year in a video, ICE is like cigarettes. It is a cash cow, because if you're phasing out ICE, there goes your CapEx right back. In ICE, you can eliminate the CapEx that goes into that. So I'm not too concerned about the level of the debt that they have. Their cash flow can service it, and they are investment grade, so I'm not concerned. TLT March 2024 call. I bid 525 today, didn't get them. I'm wondering roughly how you determine what price is a good price for you to enter. Eyeballs. I just look at it, and depends on how I feel. Said you want to enter the 105 call sub 6. Just wondering your thought process. Just because that's, I look at 5, under 6. I think, well, that makes me feel better than a 7. That's all. There's it wasn't 12 spreadsheets in a committee with 3 factor models. It was just I don't want to spend more than $6. I'd like to get it for 5. And now today was bid 525 to 560. I bid 525, and TLT rallied as the market dropped, so I didn't get it. But if there's any weakness and I see it go the bid 525, 525.10, then I'll change my mind and say, you know what, I want to get it for 495. On a good sell off of TLT, let me see if I can grab it for 495. Or I might say, well, never mind the 105s, let me move down to the 104s or the 103s. Depends. I guess the answer is it's more art than science. Even though home builders have been on fire, would you think tactically selling calls? No, I'd never sell calls on. They're hitting 52-week highs week after week. I sold puts on Toll Brothers today because they had earnings. And, of course, they knocked the earnings out of the park. Home builders are they're unstoppable at this point in time. They have, every condition for them for success exists in the market today. Every condition exists in the market today for them. And they're just on fire. I sold more puts on them today on all the home builders and on the XHB because they've 2 days now they pulled back very nicely. DHI went from like 112 down to 105. Lennar pulled back about $8 as well, $6, $7, $8. So I sold puts on Toll as well, and they had great earnings, so that was a nice one. But I would not sell calls. I've been watching the videos for almost 3 years. Here's my question: by being short on tactical, you mean, for example, you started with negative 0.3 delta, you keep that delta, right? I don't look at it per position. I just look at it overall. But okay, let's go with that. After negative 3 becomes negative 7 after the rally, you hedge by selling some put. Yeah, that's what I would do. I wouldn't rebalance this one back. I would rebalance the position back by adding something on. Exactly. That's what I mean by being tactical. Yeah. By the way, when would you roll forward in time? The call's expiring in June 30th for September futures. I wouldn't. I don't know that I would do anything there. I'm looking past that date on the assumption that I'll have some that are assigned to me. Well, right now, none of the puts. I don't think I have any of the puts that would be assigned to me. I think a couple would be assigned to me. Most of them are lower prices, but I'd have contracts called away, which would give me an even larger short position. If something is put to me, it would cover my short position. So I'll have a few covers on my short position, but my calls are all in the money in the sense that they'll all be called away from me, but some puts will offset those. The spreadsheet that I use to track it has a column for each call or each put and the value they are at different strikes. And then I sum all of the columns so that I can see exactly where my break-evens happen to be. And I have lots of profit potential all the way down to almost 3,700 I'm in profit. So I can afford to sell some puts to bring that up to push my break-even higher. So a little bit complex, but what do we got here? Could you please give some advice to a novice investor on how to generate a steady stream of investment ideas to keep the backlog healthy and be ready to execute? Find a sector you like and find an ETF that tracks that sector. And an ETF is like a bibliography. Look inside. You've got, 47 ideas in there. Right there, you got 47 ideas. Or 55, however many stocks are in that particular ETF. So, you like home builders, look at XHB. XHB has some home builders and home builder suppliers. And I think there's something like 60 some components in there. Well, there's 60 some ideas right there. If you're looking for momentum, watch the 52-week high list. Every day, stocks that are hitting 52-week highs land on that list, and you can eliminate the preferred shares. You can eliminate sectors you don't understand. You can eliminate the takeover companies that got a takeover, and that's why they popped and hit it. You can eliminate all that, and you bring it down to a few, and then there's some ideas. So there's a couple of ways to look for ideas. Currently, I watch Bloomberg, Morningstar, read Seeking Alpha, and try to be interested in the world around me. Yeah, that's good too. Ideas can come from all sorts of places. Sometimes due diligence results in a buy, other times in nothing. Yep, that's normal. I have some action on the option, several long positions. Always feel that I don't have anything in the pipeline if the market decides to take this action away from me. So what you want is a number of stocks that you would buy if they pulled back 10 or 15%. I've got a list like that if these guys pull back, I'd either buy them or I would heavily sell puts on them. I have that. And then you have some where, if the ones that I'm holding, if they get to certain prices, I'd sell calls on them. So I always have something going on in that respect, but I try not to get too far afield. If you find that, I got nothing to do today, sometimes that's the best thing, is just wait for the market to do what the market has to do. This idea that I have to keep putting positions on or keep doing things, if you don't understand the risks that you're taking on and how they correlate with all the other risks in your portfolio, you might end up with what you think is a diversified portfolio, but they all load on one factor. And when that factor turns negative, every position you have is losing, and you can't figure out why. Thoughts about portfolio management on dollar delta beta, dollar delta duration. Taking a simple 60-40 portfolio. What I think the weightings of DB and DD are 60-40 as well. Well, you could weight your factor exposures, or you could just weight your dollar amount, right? You say, well, I'll be in equities and I'll be in duration. I think a better way to do it is to weight your factor exposures, because then you have a true 60-40 portfolio on those factors. You have to be careful with your equities, though, because some equities do have high effective duration. REITs have very high effective duration, which means they are interest rate sensitive. And high yield corporate bonds have very low effective duration, which means they tend not to be that interest rate sensitive. And are more business cycle sensitive. So you want to make sure that the duration you have truly, that whatever you have, its empirical duration is very close to its effective duration, meaning that it actually is interest rate sensitive, and that the equities you have are less interest rate sensitive. Let's see. Meanwhile, I also notice that all three levels of CFA doesn't cover this portfolio management method, so I'm wondering. Yeah, it's more of a retail. Well, it does in a sense. Like, you touch on factor portfolios, you touch on risk budgeting as well, but it doesn't really get into the operations of it. That is typically left for your work experience will fill in all of those holes. But you would be aware that, well, I could build a diversified factor portfolio, for example, that has exposure to certain factors. And you would you could follow a risk budgeting approach where you have, for each exposure, you have an equal amount of risk coming from each exposure. That would allow you to size the position so that something that has, let's say, a beta exposure but a very low beta, you'd have a higher allocation to it from a risk budgeting perspective. So it does cover it in a sense, but not operationally. Just wondering, would you like all these eyes on you and also report your coffee mug accident in the news? No, probably not. I'd have to talk about my coffee mug and what it meant to me, and I don't know if I could get through an interview. I was recently given the opportunity to interview a bond PM who manages a total of roughly $30 billion. Whew. If you were me, what are some questions that you would ask him? I don't know that I have too many questions for a bond portfolio manager. I think that the one question I would ask him right now is, bonds seem to be acting quite rationally. What do you make of equities? I think that's what I'd want to get out of him is, what do you think is going on over in equities? Are they a bunch of clowns, or is there something that we're missing? And perhaps he might have some insight into that, but usually the smart money is in the bonds, so I don't know that I'd be too interested in the bond stuff, but I'd like to know what his opinion is of all those people on the other side, those equity people. See what his opinion of that is. Are they out of touch? Is pain coming to them when they realize that the yield curve is going to be where it is for quite some time? In fact, maybe even a steepening of the yield curve without the front end dropping. How are equities? Do you believe what equities are doing? I'd be all over that. I think. Home builders from the sidelines past few months. And like you, waiting for a chance to get back in. Well, these last 2 days have given you a small chance to get back in. Long-term prospects are all very bullish. Short-term, countrywide, you see permits down year over year noticeably. Construction starting to taper off. Construction salary growth of over 5% year over year for about a year and a half now. These companies, at least the ones I follow, negotiate outside contracts for buildings, so these costs should come in with a lag. All the bullish opinion pieces post-earnings I read were focusing on hitting revenues above guidance, but the decreasing margins and the impact on the bottom line seem to be overlooked. So to me, in order for these companies to not end up short-term overvalued, it's kind of a bet that house price increases can offset these headwinds in the short term. Maybe they can, but I'd feel better taking position again when these factors start all moving in a positive direction. I think they overextended a bit. You've had some pullback in the last few days. I'd like to see another day of pullback, and I'd probably sell more puts. I did sell puts today. If I get a pullback tomorrow, I'll sell some more. But I don't know that I'm going to get a pullback to the 200-day moving average on these, barring something really bad happening, like no debt ceiling period, and it's not just a dog and pony show, but that each side is drop dead serious and knives are out, that kind of thing. As a Canadian trying to buy a home, pray for me. Yeah. Let's see. Really sad news regarding your coffee mug. Yeah. He's with my dog now. My dog died 18 months ago. My coffee cup is with him now. Given the theme of 80% of SPX performance being owed to just a handful of megatech stocks, I'm wondering if you have any thoughts about how this might change using beta. The implication might be that beta relative to SPX of individual tickers is now slightly less reliable. I have thought about that. That if I'm baselining my beta to the SPX and it's really these guys that are doing anything, creating a beta of 1, then maybe these numbers are not as reliable. I have thought of that. It seems, but I think it uses a 3-year look back period, so it would just be finding its way into the beta now. So if you figure out the weighting of 2 years, 9 months versus 3 months of data, it's not significant enough yet, but that has occurred to me that as each day goes by, does this number become less reliable? Like by 1 over 1,000, still, like you got 3 years, 756 days, so 1 over 756 every day, 1/756th. Let me write it down. 1 over 1/76th a day. It becomes unreliable, or it becomes more and more the S&P. The S&P 6, S&P 5, 7, something like that. It seems more and more like SPY can move up while the broader market moves down. How would you see U.S. credit downgrade affecting LTL trade? It didn't really do much effect last time. I don't know. Wouldn't be good. I can certainly say, well, I wouldn't say it would be bullish. I just don't know if it would be bearish, but certainly not bullish. Based on what I understood in the TLT slide, you were going to be selling calls on it. No, I'm trying to buy calls. I'm selling puts. However, the commentary after suggests that rates are likely to remain the same or decline. Would that not prompt a rise in the ETF? Well, if rates decline, yeah. I don't know that rates will decline. The more salient a recession becomes, the more the market will push rates down, because bonds are seen as a good hedge against inflation. So if they're a good hedge against inflation, then they don't need such a high term premium. So the term premium will come out of the long bonds. But the TLT position I'm taking, I'm pretty much relegated to it being a crisis trade. In other words, something broke, and it's significant. That's really, I think, where that trade is going to pay off. In the meantime, there's a dividend, and I can work the options. I'm not concerned about working the options on this one. I'm thinking of selling lots of puts on lots of time frames for TLT. Don't do it. The strike of 92 being the 52-week low from last year. What do you see as likelihood and the scenarios of it crashing to that 90? It doesn't matter if it crashes to the 92 level. That doesn't matter. It matters about the volatility. It can go from 100 to 95, and volatility could spike. And if you have, I know what you want to do. You want to do a strip. There is a thing called a stack and a strip. A stack is where you sell a whole bunch of calls every month, and you close them, and you sell a whole bunch of calls next month. A strip is where you go further and further out, and you get higher and higher premiums each time. So instead of having them all on one, you have them distributed across time, and then when these expire, you add to the end. If volatility spikes, all of these go up. You get the margin calls. Especially if you're playing at the limit of your margin, you're going to have to start closing some of those down. And the further out you go, the more illiquid they become. And when volatility spikes, those spreads widen. So getting out is going to be painful. So don't do a lot. Don't do a lot. That would be my suggestion. In regards to mining, do you have any opinion on Newmont? It has underperformed the sector lately because of a recent large acquisition. Thought it was a reputable name in the space, but I find it challenging to analyze the company's financials while they're undergoing an acquisition. Yeah, I'm unfamiliar with most of like there's just hundreds of mining companies globally. I'm unfamiliar with most of them. So this one here I don't know personally. What do you mean when you refer to average cost basis? Is this specifically for tax treatment? Well, yeah, tax treatment, and also if I know my average cost basis and I need to sell options somewhere to protect myself from something, at least I know from what my starting position is that I want to protect myself from. That's all. And when you sell calls on agency and they aren't called away from you, it lowers your cost basis. That is true. Interest significantly better. That one was too gaudy. My God, it's no pleasing you people sometimes. Earlier I asked the question why the futures on Eurostoxx 50 were in backwardation. Well, now the situation has changed again. The future curve went back in the contango. Europe has dividends, I think, once a year. Once a year. So being that the futures price will reflect the benefits of carry, and if you have a large dividend, there is a benefit of that carry, it will be reflected in the futures price, so it may cause an oddity around that time of year. I know that I hold Stellantis, and it just recently paid its dividend, and it's once a year. Like, it's just once a year. So that could be the issue that you're falling into there. Could this be an indication of the bull market running on steam and sellers of the futures require? No, futures are priced on what's called a no arbitrage basis. If it wasn't priced that way, then arbitrage would step in and make it so. So there is a formula for pricing the futures that is based on the spot price, the term to the futures expiration, the costs to carry, which are usually the interest rate, and the benefits of carry, which is the dividend. So it is a mathematical result. What is a good contribution plan to have if you're working with a small account? Should one be allocating each month where the account reaches a certain balance? Well, I think over the course of your life, you'll continue to allocate to a savings plan, whether it be into a registered retirement account, whether it be into a tax-free account or a taxable account. For your whole life, you will have some saving strategy. I seem to think that 20% of your income is a great target to hit if you plan to have the ability at 50 or 55 to say, I'm done with things. And if you have a high income potential, if you're going to be a university graduate, you have a high income potential. If you can live on 80% of your paycheck, then great. Most people will live to the size of their paycheck. So if you can size your paycheck to only be 80%, you won't notice the difference. Most people, they spend money, and then whatever they have left over, they save. Warren Buffett says, save, and then whatever you have left over, you spend. Have your savings plan first, and then whatever you have left over, you spend. 20% of your income is not really that significant. I think RSP contributions in Canada allow up to 18 or 19% of your income, up to a threshold, I think, of 27.5 a year, something like that. If you're maxing out your retirement plan every year, you're probably hitting 20% of your income anyways. So it's not unrealistic to be saving 20%. Unrelated to the market commentary, seeking your feedback. Landed a role as an associate in private equity for one of the pension funds based in Canada. I do not have any investment banking experience or background, nor do I have a background in consulting. Well, they hired you knowing that, which means they have some kind of apprenticeship or training program for you. My background is a mixture of operational, commercial banking, and sub-debt. What will be your top 2 or 3 pieces of advice to be successful? Well, learn. Learn and read everything you can. Listen to people, shadow people, I don't know that I'd have 2 or 3 pieces of advice that are specific to that. You don't have the background for it, which means your first little while is to absorb as much as you possibly can and ask questions, but do not be a pain in the ass. Okay? I mean, it's okay to ask a question every now and then, but you should have done all of the heavy lifting that you can possibly do first. And when you hit a wall and you fought with that wall and you can't get around it, then you ask a question. But don't approach somebody with, your book open saying, what's this, what's that, what's this, what's that, can you explain this, can you explain that? You will wear out your welcome very, very fast. These are busy people. And if you have, very specific questions, they'll be more than happy to answer it for you or direct you somewhere where you can get those answers, but don't be a pain in the ass. But learn. I have an opinion on the AI discussion. I'd like to know your comment. I agree the market has turned into the S&P 5 again. Well, that's clever. And I get the hype around AI, but considering the market being optimistic and forward-looking by nature, couldn't the current move be justified to some extent by the fact that AI does not seem to be very far to be implemented in various parts of the economy as a real solution to 2 current main problems, productivity and labor? It is the promise of a solution to 2 main problems, productivity and cost of labor. It is not there yet. It is a promise of that, a very good promise. and a promise that we'll continue to perfect and continue to walk towards that solution, but it's not there yet. But that was the .com. It was the promise of a whole new economy, a digital economy. It wasn't there yet, but it was the promise of it, and we were making steps towards it. I think like 99% of all those .coms disappeared. They completely disappeared, and I think a lot of these AI, a lot of companies that are implementing AI will at some point say, you know what, it hasn't paid for itself. It's not to the level where we need it to be. Maybe in 5 years it'll be there. So we'll let Google develop it better. We'll let OpenAI develop it better. They'll be suppliers of AI for us. We don't really have to worry about it. But you want to boost your stock price. Say you're doing something with AI right now. But I think a lot of companies will get to the point of, the promise just isn't there. I am, in fact, remembering you had mentioned one of your videos that automation could be one of the next cycle's winning themes. Yeah, I think it is. I think it will be. Is more of that in the next cycle. I think ABR pulled back because of the dividend. My ABR got called away right before ex-dividend day. Another question on the mini bubble thesis. How do we honestly assess the presence of a bubble? Well, you don't, right? The bubbles are obvious looking backwards. They're not always obvious when you're in them. I know we're seeing bad news forecasts not affecting the S&P, but can we honestly credit mega caps and their expected AI growth for this? Well, I think so. I think some of the buoyancy in this market is AI related. I'd love to assess whether or not we're in a state where many market participants actually believe FOMC commentary on the base case soft landing. I don't know. Could one not suggest that if there were a mini bubble, the tech mega caps would pump harder and higher and skyrocket to an unprecedented multiple? They're all around 30 right now. I'd argue that Amazon, not just a tech company, they're at 275. Or do you believe the tech mega cap multiple expansion in its current environment is in fact quite significant? So these companies are not pure plays, right? In the .com era, it wasn't a question of, this brick and mortars company is opening a website. They went nowhere. Companies that just adopted it went nowhere. What really went crazy were the companies that were just going to be pure play. They had no revenues. They just had eyeballs. They were gaining eyeballs. They were spending money to get eyeballs, and they were just going off the charts. Look at EV. When EV exploded with Rivian and all of these companies, they had $40-50 billion market caps. GM has a $40 billion market cap. And there was a period of time where Rivian's market cap was twice that. And they were planning on producing, 500 vehicles that year against GM's 6 million? So it wasn't about what they were going to sell that year. It was the pure hype around EV and what they're going to be in 10 years. And you were going to pay for it today. So if you have pure play AI companies, yeah, they're going to be valued ridiculously. But a company that has that has whole operations right now that adopts AI in their organization would be like a brick and mortars company in 1999 saying, well, we started a website. Yeah. They got no respect for doing that. Have you seen any recovery or market entering new bull cycle before the yield curve normalizes in history? No, I have not. That's the curious thing here. Still short beta the portfolio? Yes, I am. But today with the pullback, I took the opportunity of lowering because I'm negative on it. I lowered it by 2 million. My dollar delta beta brought it down by 2 million. It sounds like a lot, but keep in mind it's dollar times delta times beta, right? So it ends up being big numbers. I'm going short. Max short when Mark finally capitulates. Yeah. I got close yesterday after watching the reaction of the market to somebody saying 2 more rate hikes, and it just shrugged it off. There was a period yesterday where I thought I may as well do something here because what's left? The gun is empty. All the bullets have been fired, and this thing keeps getting back up. You don't really check gamma risk, right? Not really, because I don't. Some of these things I want to be assigned. I'm okay with being assigned. That was the point of selling the puts. Is I want to buy it, but I want to buy it cheaper than what it is. So I want to be assigned. Sometimes I close them if I think, well, I can roll them for a better price. Then sometimes I do, but no, I don't really pay too much attention to gamma. When the market's in a bull market and I'm running an income factory, then yes, I will. Because the purpose of the income factory is to generate income, not be assigned. It's to generate income, and you want that income and nothing but that income. So yeah, I do watch it then, but not now. Too choppy. And where are we going? Well, it looks like we're going up, but are we? When you sell puts for capital gains, do you profit at 50 cents? Sometimes. Depends on where the underlying is. So if I sell a put at $50, let's say on a stock, I sell a put at 50 and it rises and it's at $60 and there's 15 days to expiration. Let it ride. Why am I going to close it? It might be. The bid might be 10 cents to 15 cents, and I think, why would I pay? If I've got 60 of them, why would I pay to close them? Let them ride. I mean, but if it's at like 52.50, and there's 15 days to expiration, and let's say I had originally sold them for $2 and they're 78 cents to 82 cents, I would probably look at that and say, well, yeah, why not take it? If I don't want it assigned at 50, if I do want it assigned at 50, I would let it run. It's part art, part science, right? I know how you pick your strikes has a lot to do with how your portfolio is currently positioned. I want to ask to see if you follow a combined delta method or a target delta when you pick your short put delta in selling your future options. Sometimes I do look at what delta I need. Other times I look at what dollar value I need. So if I'm selling puts, I might argue, well, I need this much premium total. So I might say, okay, I need $800 in premium. And the premium on these puts is 50. So I have to sell 16 because I need 800 to get something done somewhere else. That I want to raise my average break even by so much. I need $800 in premium on that, knowing that each one I sell is 50. That's 16, right? So sometimes I do that. I know you have short calls on futures and you sell puts to be tactical. Your short put strike seems too high for me and feel it will work against if the market were to go down. Yeah, that's, but if you don't do it and the market goes up, it's the same thing. You have risk on both sides, right? Just trying to understand the process behind what delta to pick on short put and where and how to hedge that short put. Figure out what your break-even points are, and what you want to do is sell it in such a way that you raise your break-even point to the upside, maybe 15 points, knowing that you'll have to raise your break even to the downside up by 15 points as well, but determine where the risk lies. What risk events do we have in front of us? You have PCE on Friday. You have a debt ceiling thing that may get solved. You have a growing AI chorus going on out there every day. Another company is saying AI this, AI that, because it is the hottest ticket in town. Maybe we've gotten to the point where investors are sophisticated enough to say, okay, it's a bubble already. I'm going to avoid this. There's going to be maybe we've seen it so many times that now it's like, okay, look, maybe. I don't know. Looking at options chains, how do you tell which option price is overvalued or undervalued? I don't waste my time with that. I know that there are some people who look at those things and will do arbitrage on those. I don't waste my time with that because, here's how you would look at the implied volatility. And the further out of the money you go on puts, you'll notice the implied volatility increases. Well, That typically can't be right based on what historical volatility is. So there are some people who play those tails. It's not my thing. XLRE has quite similar components like IYR, but much lower fees. Well, you got to look at the options. If you're playing the options, you want liquid options, right? Let's see, how many more do we have here? Oh, I may not get through all of them here. I'm just looking at the time, 9:30. Let's see how far I can get. As of lately, we've seen stress in some regional banks as the value of long maturity bonds in their book plummeted, causing the market depositors to panic. Okay. Some pundits say that if this continues, the Fed might be forced to cut rates to alleviate the situation. No, they won't cut rates. They'll cut rates for a credit problem. That is not a credit problem, that's a liquidity problem, and they've already solved the liquidity problem. I see the other way around. The best way to float up the value of those bonds is to push down the long end of the curve, not the short end of the curve, by provoking a flight to quality. That usually happens during... They don't have to worry about pushing up the price of the bonds because the Fed has said that they will accept all those bonds at par as collateral. Not at their current market value, but as par. Problem solved. Problem solved. So we can ignore number one. Regarding debt ceiling situation, no arrangement is reached in U.S. defaults. Banks will probably tighten up. Credit flow will free. Well, yeah, a lot of bad stuff will happen very, very quickly. Anyone with cash will hold tight to their dear dollars and rates will skyrocket. That is bullish for the U.S. If, on the other hand, arrangement is reached, Yellen will immediately issue at least $500 billion worth of bonds to replenish the malnourished TGA, so she will hoard plenty of available dollars from the market. Yep, again, that is bullish for USD. Seems to me like, one way or another, there are tailwinds for the U.S. in the near future. Would you agree to this? Default, I don't know, would be bullish for the U.S. I don't see that as being bullish for the U.S. at all, for the USD. No, I don't think that would be. Anyone with cash will hold tight to their dear dollars. Well, imagine that there was no debt to buy. Where are all those dollars going to go? Now, if the Treasury issues a bunch of debt, it will soak up dollars out of the marketplace because all of those savings have to go somewhere. They'll go into bonds and they'll soak up those dollars. So it's kind of the other way around. No, I don't think it would be, a default would not be bullish for the USD. And a debt resolution, I don't think would be bullish for the USD either. I think if you get a resolution to the debt ceiling and the Fed is on pause, that is bearish. All of that is bearish for the US, for the USD. I would go the other way around. I'd say bearish. Let's see. Let us know the day you decide to adjust your SPX position so we can inverse accordingly. Your sacrifice will be remembered. Yeah. Let's see. Just opened a small 300,000 position on care. It wasn't 300,000. I sold some puts. I think you're saying that the total of it, the notional amount would be 300. Yeah, the notional. Well, notional is not a big deal. That has worked out 2 days now. That's been a beautiful speculative bet, and it was just speculation. I honestly don't have an idea what I'm doing on this one. It just was speculation. You mentioned you close option trades at 50%. What do you do after that? If I sell a put GM at 0.3 delta, 10 days later, this delta is 0.1, so I close and take my profit. Do you sell another put at GM at 3? Yeah, that's what you do. This put would have a higher strike. Yeah, that's what you do. Then what if the stock moves down? That's the game we play. That is the game we play. But standing in one spot isn't going to help you. You have to move, as long as you're moving with a moving average. So if you're selling 0.3 deltas every 2 weeks, you will be selling on the moving average of that stock. Some will be put to you, some will not. Those that are put to you, you take them, and then you start selling 0.3 calls, 0.3 delta calls on them. And sometimes they won't be called away from you. Sometimes they will be called away from you, but you'll be selling them on moving averages. So you just have to have you can find an underlying where you can back test that point three strategy and see how bad it can get. Or how good it can get, or what's the most that you'd be the most that you would be put to before it gets called away. So you have to engage with the market. You can't just let it keep coming to you. It's kind of like being in a club. You can stand by the bar and wait for the ladies to come and talk to you, but that's usually a low return strategy. I want to get invested in SPY. But do you think it would be a good strategy to sell out at 0.2 delta, and if assigned, I would just hold it? I mean, at least I get the income. Yeah. And what if we do not get the recession? I would just sell puts monthly until assigned, and then if assigned, sell calls at 0.3 delta. Yeah. That's there you go. Let's see. Why have home builder stocks been the correct play from a fundamental perspective? Lack of inventory. It is just one story: lack of inventory. Your opinion on Japan? Japan's just rallying, isn't it? As the yen keeps weakening, the relative cost of Japanese equities keeps dropping, right? Even if the Japanese stock prices are down 5% over the next month, but the yen weakens 5%, you haven't lost anything in U.S. dollars. I mean, and you're getting yield, right? So even though they're expensive in yen terms, because the yen is weakening, in other currencies they're cheap, and they keep getting cheaper. Every day the yen weakens, they get cheaper on either a euro basis or a US basis, or even better, a Mexican peso basis. Outside of this, there's still risk related to interest rate differential on yen. Well, yen strength, would be, if you bought a U.S. dollar ETF that held Japanese stocks, then you got a bit of a problem. But if you converted your currency to yen and you bought the yen-based index or an ETF based in yen, as the yen strengthened, the market would pull back, but your yen is getting stronger, right? Because you have currency exposure. What are your thoughts on the current situation? How durable is this rally in your opinion? It's as durable until yield curve control is abandoned. Once it's abandoned, if the yen is a funding currency in any carry trade, it will start to be unwound, which will then drive up the yen, which would then correct the price of the market based in yen. Most commercial real estate is not adjustable. Majority is still fixed. There's just more loan that are variable in commercial compared to residential. Not based on my experience. I've had residential loans before. I've had mortgages and commercial real estate as well. If you buy a commercial building, the loan is 5 years. It was 5 years. It was partially amortizing, and it was floating. And it was the 5-year Canadian, whatever the 5-year rate was, plus a spread on top of that, and it was floating. And that was just the deal. And while you could buy a house with 10% down, you could not buy commercial property with 10% down. Depending on what you were buying, it was 25 to 50%. You're buying an older building, you're 50% down. You're buying a newer building, 25%, and it was floating rate. And there was no option, because you go get a mortgage, you can go floating rate or fixed rate. You get a commercial mortgage, there was no fixed rate option on it. It was just floating. That was it. Period. You end up selling puts on Monday. It's really difficult to forecast what the market will do. Monday, it seems like the market didn't care about the 4 Fed speakers. Nope. But Tuesday, they became impatient and dropped 1%. That was debt ceiling stuff. I sold 41.50 puts on half my position today. Today, I did sell puts, yes, 40.80s. How do I get to the 40.80? I am short September futures, and I'm short June futures. and I know that I'm going to have to roll my June into September. So I add up the two quantities, right? The quantity times the price, quantity times the price, and then I figured out what the average price is, and then I try to sell puts below that. So 40.80 seemed like a good place to be for July 31st because I know I'm going to roll my Junes into September. So July 31st had some nice premium on the 40.80s. I think it was 75. Yeah, 70, about 75 to 70. I think I got one at 77.50, but in that range, 75 to 77.50 on the 40.80s, which brings the break even almost down to 4,000, right? So that gives me plenty of downside down to 4,000. Do we get down to 4,000? It's hard to see how we get 200 points or another 150 points down with the willingness of the equity market to ignore almost everything. The recordings of these live sessions. I don't record live sessions, no. Comment about the Fed isn't saying they are decreasing rates, so we should follow them while the market is. Yeah, this is because Fed also said we're doing near 0% for a long time, and that changed. Okay. Let's see. Don't U.S. mortgages have terms like in Canada? Are they 30-year mortgages with 30-year terms? Yes, they are. 30-year fixed rate, period. Canada is, I think Europe has this as well. You get a 25-year mortgage with a 5-year term. You can take a 1-year mortgage, a 3-year mortgage, a 5-year mortgage, but you go back after 5 years and you renegotiate your mortgage. Owners who have preferred rates can easily sell and port their mortgages, keeping conditions the same. I don't know. Let's see. I'm just going to skip some of these. Well, we're almost at the bottom here. What do you think of the tobacco industry? I don't know. It's not my thing. So, just not my thing. Let's see, one more here. Last month, sold some 30-day to expiration out of the money puts on high dividend U.S. security I want to have exposure to. Now those puts have gone in the money, expiring soon, which is okay. Due to the 30% dividend, 30% dividend withholding, I'd like to switch the nature of that exposure from owning the underlying as originally planned into entering a long synthetic. Yeah, you could do that. Which is the most optimal way to convert a near expiration in the money short put into it? Well, you close the put and you enter a synthetic at the same strike as the put. Yeah, just do it at the same strike as the put. When you're selling the long dated, because you're going to do a long dated synthetic. When you're selling the long dated put because it's in the money, you're simply just rolling that loss into that other put. That's just do it at the strike price. What info in particular do you seek when analyzing the volatility term structure and the volatility skew? Just the level of skew. Most of it I can see from the options chain anyways. I don't necessarily have to look at it, but I don't know that I use it that often. Do you factor them in any way when it comes to selecting your strikes? Not really. I mean, I can see it quantitatively in the options chain. I don't need to see it visually in the IV viewer. You know, because I can see it quantitatively. So I mean, all the IV viewer would be showing me is a picture of what I can clearly see the numbers drawing out on the screen, right? And I'm going to end it there, people. It is 9:46, and that's it for the week. Sorry if I missed any of your questions, but that's a long session.